Hi, I'm Shane Cratcher from IBTimes UK, and I'm joined today by John Clarke, who is Chief Investment Officer at GHC Capital Markets, and we're going to talk about all things economics today. So thanks very much for joining us, John.
Thank you.
Let's start off with the UK recovery and what your view is on it. Is it sustainable? Is it broad-based enough yet?
It's becoming more broadly based. The key as to whether it becomes sustainable is, I think, largely dependent on what happens to the quantity of money. Monetary growth has been quite weak thus far. It's been a lot stronger than it was during the financial crisis. But monetary growth so far, in the year to the end of March, broad measure of money supply has only been up 3.8%, which I think is on the weak side with regard to any expectations that we might have with regard to above trend rates of economic growth. Mm-hmm. So I think the expectation that markets now suddenly have, all of a sudden, that the recovery is going to be self-sustaining and going on forever, I think is probably a little bit optimistic.
That poses an interesting question for the interest rate hike then, because obviously Carney has indicated that he will only lead an interest rate hike with the MPC if they believe that the recovery is broadly based and is sustainable, but you're saying there might be a question about that. So is early to 2015 too early a time to think that interest rates might be high?
I think it is. For a long period of time, our view at GHC was that we would see interest rates not rising until 2016. We brought that forward a bit simply because economic growth had picked up more strongly than financial markets were anticipating. From where we are now, I think the market's looking at I think the MPC is being misguided in terms of looking at the labour market as a main guide to where the economy overall is heading. Okay, unemployment rate has fallen quite sharply, but that's only because productivity in the UK has collapsed over the last few years or so. So therefore, if you like, the labour market's taken up the slack. I really think that the economy is recovering, but we are still, if you were to draw a straight line from where the economy was prior to the financial crisis as to where we are now, and assume that it carried on at its pre-recession path, we're about 10% beneath that. So that's a measure of the amount of spare capacity, if you like, that there is in the economy. And that spare capacity needs to be taken up before, in my view, the MPC needs to think about raising interest rates. We're a long way away from that, I think. Mm-hmm. There is a danger that if you raise interest rates too early, that you'll see the economy, the recovery being sort of choked off. And
is that the biggest threat you see to the recovery, is an too early interest rate hike?
Absolutely, yeah, because okay, inflation is now down to 1.6%, and inflation is a lagging indicator, so quite clearly the MPC doesn't want to be worried about or doesn't want to be focused on inflation as it is now. It's concerned about where inflation is going to be in 2 years' time. But inflation in 2 years' time depends on where the economy is now and where the economy is likely to be in the next 6 months or so. And I think that there is so much spare capacity in the economy that inflation is likely to fall further before it then starts to rise.
On the theme of threats to recovery, one of the biggest problems, so to speak, is the housing market revival. Do you see that as a big threat, or do you think that the whole bubble talk's been overdone?
I think it's being overdone, primarily because if you look at valuation measures of the housing market, most simply compare the level of house prices relative to average earnings. On that basis, house prices are already looking really quite toppy. If, however, you look at them relative to household disposable income, the measures are really much significantly lower. And the reason for that is simple, and that is that the number of double income households have actually increased quite significantly over the last 10 years or so. And that reflects a big increase in female labour market participation rates. So unless they're all living on their own, it must mean that there's more double income households than there were previously. So therefore, household disposable income means that housing markets housing values are actually much more affordable than they were previously.
Mm-hmm. Moving on to Europe now, and the Eurozone specifically, we're told that there's this wonderful flourishing recovery in the Eurozone. Is that something you see? Do you buy that?
I don't buy into it. Okay, the Eurozone has been recovering in each of the last 3 quarters, and the data out this week is probably going to show that we will have seen a 4th successive quarter of positive growth in the Eurozone. However, most of that's going to be skewed towards Germany. In fact, if you take out Germany, you would actually see that the Eurozone has increased by just 0.2% as a combined total over the last 4 quarters. So the Eurozone as a whole, excluding Germany, is not really recovered at all. The thing I'm worried about with regard to the Eurozone is that money supply growth is pretty much basically zero. And if you look at the main driver of monetary growth, which is bank lending in the Eurozone is falling, and that includes within Germany. In the last 12 months, bank lending in Germany is down 3%, bank lending in the Eurozone as a whole is down 3%. Unless that turns around anytime soon, it means that money supply growth, which is pretty close to zero across the Eurozone, is going to carry on weakening. That means that you will not see sustainable rates of growth in GDP across the Eurozone as a whole for quite some time to come.
So why is that? Why do you think bank lending is stagnating?
A combination of 2 things. One is that the household sector and the corporate sector are not yet sufficiently happy enough to, or confident enough to actually pick up their demand for lending. But there's also a more profound problem, which is that as a result of the financial crisis, the banks have been forced to hold higher capital to asset ratios than they were previously. They can do that in one of 2 ways. One is to increase their capital, which means they have to then sell more new share issues to the private sector, which reduces the quantity of money. Or secondly, they can reduce their asset side of the balance sheets, which is dominated by their loan books. So they can either so basically they've actually cut back on their lending. Unless that turns around anytime soon, then money supply growth is not going to pick up.
There's a big tension there, isn't there? Because obviously they're being told to lend more because all the policymakers want the economy to grow, but then they're also being told to hold more capital because if you don't, then we're risking another big crisis.
Yeah.
So
This is the divergence between politics and economics. The economic story is really quite simple. If you want the Eurozone economy or any economy to grow, you need to aim for something like around about 5% rates of growth in broad money. We're now seeing that in the US quite comfortably, hence the economy is recovering. We're seeing around about 4% rates of growth in the UK, and there are some worries about where that might be heading in the short term. But in the Eurozone, monetary growth is basically zero. That's why we're not optimistic about the Eurozone. We need to see something happening. Okay, the ECB is widely regarded or widely expected to announce something in June, but I suspect it's going to be doing the wrong sort of QE. By that I mean they're going to be buying bonds from the banks as opposed to the non-banks. It's quite technical, but essentially what that means is that that will have very little impact on the quantity of money. If that is the case, then the economy will not recover the way financial markets currently expect.
thanks very much for your thoughts, John. We really appreciate it.
No problem.
I'm Shane Croucher of IBTimes UK. Thanks for watching.